Morning, folks. You guys can give me a heads up on the audio. You should be seeing the charts now. I'm checking Twitter. See if you guys can hear me. Just give me a 5x5. Momentum, thank you. Cynthia Max, thank you, sir. All right, so Eduardo, thank you. All right, so we have a economic news driver out in a couple minutes. Bro says, I wonder if the trade, if it didn't pan out, if it would have been recorded and shared. He wasn't watching the live stream yesterday, apparently. And you wonder why I do it like this. It's entertainment. All right, so we have the 1 minute chart over here, and I'm going to take all this stuff off here because it was in the recording. So you can watch that whole business pan out on the Twitter example I just shared. The management, the entering, all this. But I want to go out to a 15-minute chart real quick because we have a few minutes before we get to the news driver. All right, so going into this economic news, they use these as volatility injections, meaning that they're going to use it as an excuse, basically, as to why price moved, when in fact it's just manual intervention. Today is Wednesday of non-farm payroll, and this is typically when I tell my students to sit still, don't do anything. If you haven't made money on the week yet, don't bother trying. You can demo trade, you can paper trade, tape read, whatnot, but Wednesday after 11 o'clock in the morning, the market gets into a very challenging market condition for new students, not experienced traders. I'm not saying that if you don't know how to trade, obviously you should be in here when the market's more inclined to be problematic. So we have sell side here. I will be short today, so I'll probably be here till like 10 o'clock, and then I'm going to bounce. I want to get caught up on some things for the house that I want to make sure I have plenty of. If you haven't already gone out and stocked up on some things and you're in the United States, you might want to do that. Because I was out last night getting bottled water and paper towels just to get some more of them, and it was wild. It was like Black Friday when everybody gets out and goes crazy shopping. It was just like that. All the water was gone, toilet paper gone, paper towels gone, and it's because of the strike with the dock workers. So just a little public service announcement. All right, so that's my focus for where I think they're going to target individual specific liquidity. Now, above this liquidity, we have this SIBI in here, like that. And then, if you recall what I opened up the week with my analysis, I showed you where on the weekly chart, the blue shaded area here on this 15-minute chart here, that is the weekly buy side of balance, sell side inefficiency. and that's the midpoint of it. So the weekly BISI. That was the framework basically off of this entry, this drive down in. All this movement here was based on just anticipating a run up into these relative equal highs right there. Because it's pre-market, because it's non-farm payroll protocol, meaning that you got to keep things real light. Try to be nimble as possible, or don't trade. If you can't be nimble because you don't know what you're doing, it's better to sit on the sidelines Wednesday, Thursday, and Friday of non-farm payroll. Yes, non-farm payroll is an event at 8:30 on a Friday this coming week, but it's the conditions that week, every single month, this is what we do. But we always try to go in and try to trade on the Monday of that week, because the early bird gets the worm here. Okay, it's not like the analogy where the second mouse gets the cheese. In this case, it's the early bird gets the worm, and you want to be able to get in there and find the setups when they're clean on Monday and Tuesday. After that, things get a little bit more 50-50. And as we get into Thursday, it becomes a whole lot more potluck, and it's challenging for a new student. So to protect them, also to remind them that their infancy as a speculator or student in price action, it's not going to serve them well to be in there trying to do something, because it's going to frustrate. It's going to cause you to second guess. And you're probably going to do it wrong, and you're going to retain that and immortalize it as something that was painful for yourself, and simply just avoiding it, not trying to push push a button, trying to make yourself feel good about getting something right. Don't expect to be right, and that way you can't hurt your feelings, right? So we have a little bit of sell side resting below here. You can see it here also on the 15-second chart. Sell side's below there, and we just traded to the top of that weekly buy side of balance, sell side inefficiency. Now, because we hit our target, I opened up with on Monday, we traded down into it. We left a little portion of it open. I favor an attempt to try to go higher, only because of the long-term trend being bullish. It's an election year. They're trying to fluff this thing up. So just be mindful of that. So over here, if you look at this portion of price action, we've disrupted these relative equal highs, traded up into this sell side imbalance, buy side inefficiency, right there. And then there's a small little minor buy side liquidity pool there. Now, if it would have done something like this, watch. If it would have dropped down, traded below both of these lows here initially, and then rallied up and had this fair value gap like that, I would be in there long as it went below that candlestick. And I would look for a run up into there. But because we haven't done that yet, I'd sit still. So there's conditions. If this, then do that. If it does this but hasn't done something else, then you have another decision making. Notice we're in the upper quadrant of that weekly buy side and balance, sell side efficiency. Everything in the blue area, that is that weekly chart. And let me, I might as well just take you out there, right? Remind you, because I know some of you haven't watched everything, or you cherry pick what you want to watch because they're too long of a video. Get to the point. Here's that buy side imbalance, sell side efficiency, this individual candlestick. That's that blue shaded area I told you when we were up here. We were likely to trade down into that this week. And we've done a swimming job of, like that, swimming, guys across the pond. That's something right out of your vocabulary. See how we got real close to the low of it, but then we stopped. So and we are here now. So if it's going to go higher, I'd prefer it to go down here and disrupt all this stuff here because this is too smooth. And even though we have nothing really to speak of at 8:30, the algo usually uses 8:30 anyway because it's coded to do so. Meaning that price will start spooling around 8:30 going into the 9 o'clock hour. And then it'll be the countdown to the opening bell. So let's go back. Put this in a 5-minute chart. Got a lot of feedback from yesterday's live stream. You guys liked it. Hey, give yourself something to do when you're watching price action. Practice. It's not about being right or wrong, but you'll condition yourself to see what it is you're asking me to teach you that only experience will give you. The right fair value gap. As you are probably aware, things have kicked off over there in the Middle East, and that is going to be a little bit of a stick in the craw for the markets. So they will not waste that opportunity, obviously. They will punish individuals that don't know very much about trading. There's a little minor buy side resting there as well. So at the moment, as we go into 8:30, we have this buy side. Top left, and then we have the again, unless something really unexpected comes out of left field, like some kind of personal, not personal, some kind of Middle East event that really is shocking, some kind of major attack unfolds, I don't expect the market to drop. I expect it to try to keep working towards its higher long-term trend. And that's because it's an election year. So they're constantly fluffing this thing up. There's no reason for stocks to be where they're at, but that's the game. It's rigged, it's artificial, and stupid people think that is a barometer for the economy, and it's not. It's the scoreboard for stupid people versus smart people. Okay, see that? See this volume imbalance here? That actually overlays with this little fair value gap ahead of that minor buy side. And then we have the buy side here at 996 even. So there's two things converging there. And there's a small little volume imbalance as well. What's the benefit of having the expectation that a less informed or less experienced student studying price action, why should they try not to trade on the Wednesday, the Thursday, and the Friday of non-farm payroll? Because what you're going to demand in terms of accuracy, precision, correctness, not that that's important, but in the beginning, you as a student, you emphasize that more than it's required. You have to be very forgiving in the beginning. So if you have given yourself the permission to not engage during these times, you will not pick up bad habits. You will not create toxic thinking. You'll not have a bad experience when you're probably going to go into it looking for these tools, these concepts to do well in your hands. When everything, every school of thought is going to be spinning their wheels many times on this week, because yes, everyone's approach can find a setup, but if you keep trading, eventually you're going to get beat up because the market tends to just not want to go anywhere. It just sits still and it trades in these small little tiny ranges. And by defining where the closest buy side or buy stops or the closest sell side or sell stops, where they're at, you can get a better feel for what they're trying to attack. And usually whatever initial sell side or buy side's taken, all you have to do is flip it and go the other direction. That's usually how I approach if I'm going to be trading on the Wednesday, Thursday, or Friday of non-farm payroll week. I'm usually doing that. So I identify the pools of liquidity, and I want to see them engaged, trade through them, and then once it does it, I would expect it to trade to the buy side here, or vice versa. If it trades to the buy side here, because we're in this part of the week where I don't expect sustained price runs. Like I don't look for that. So to be nimble, you look for these types of things to study and practice. And if you get stopped out, or if it keeps running, who cares? You treat it the same way you did yesterday. Everything's a new learning experience. So look what they did. They took it up real close to these highs, but stopped short of it. And now we're sitting down here at the top of that weekly buy side imbalance, sell side inefficiency. And we traded down into this volume imbalance and order block. So if it's bullish, it should start to spool here and run to the buy side. What would make that idea stronger? If it would have started by going down below this low here first and then traded where it's at now. Not that it can't do it at this outlined here, it just means that it's better to do that. Now why would that make that better by going down here first? Before every substantial price run, or let me say differently, before every significant price run. What's a significant price run? Something that you can trade it, you can predict it, and it has a price run that is not just 10 handles, not 20 handles, but 30, 50 or more. That type of price run usually is the result after seeing some kind of liquidity taken. And in this event, we see relative equal lows. Think about the higher time frame. It's bullish. It's an election year. They keep propping it up. Anytime it goes down, they keep sending it higher. So if it goes down to take sell stops here first and then rallies up, it's easier to trust any discount array if it does this first, because it's already taken out people that would be profitable, right, if it went higher. So by going down, it tricks people into thinking it broke support, so therefore they're going to go short on a breakout. Or it goes down below that low to stop out anyone that's long, so they're not allowed to take a ride higher. So especially during the Wednesday, Thursday, and Friday of non-farm payroll week, this is my initial go-to strategy where I'm looking at watching price. I have to identify where the near-term buy side and sell side is, and I have to wait for one of these liquidities to be taken first. We have not seen either one of them yet. So that's why we're indifferent right now. We're just sitting still. I'm just outlining if I would have seen this one taken first by going down first, and then it rallied like that, I would have been using the things up here, as I mentioned earlier, to get long, to take a ride up into this here and maybe explore it if you can get to a higher time frame pool of liquidity. But because we're just still building these areas where stops are building, there's traders in here doing buying and selling. They are absolutely happening. But the buying and selling pressure has yet to take them below the lows or above the highs. So since it's a game of, well, we'll borrow the term I used for the drill yesterday. It's a game of volatility pinball, where it's just going to bang around and knock into stops and not have any directional bias that is going to serve you on the daily trend. So avoid having the mindset of having a daily trend or a trending day on non-farm payroll weeks. Just expect it to be range bound. Expect it to bop, go to the buy stops, bump them, do like a broken wing trick, like, okay, yeah, I'm gonna start trending higher and then stop, go back into the range, or trade down to the sell side and then go right back in the middle of the range again. So it's not like we're trying to time a trend entry. We're just looking for how the market will use the liquidity. And you can clearly see that they did not take those yet, and they did not take these yet. So these are the initial ones. And because they're so close to the market, that's why they're minor sell side liquidity. Primary buy side and sell side, we look at that when we get into 9 o'clock. At 9 o'clock, the same thing I just did here on a 5-minute and 1-minute chart and 15-minute chart, you would annotate that same way, looking for clean highs, clean lows, or a singular high or a singular low. And they are your primary buy side and sell side liquidity pools. But you don't look for them until you get to 9 o'clock. Why? Because you're waiting for the opening bell. And after the opening bell, it's going to run for one of those pools of liquidity. What you're trying to do is you're looking for instances where you already have a higher time frame, daily, weekly. The market's already drawn to where I outlined on Monday. Like I'm completely satisfied for this week, but I'm just streaming because I told you I would do it this week. But we don't have to spend the entirety of what we've been doing the last 2 days. I'm only going to stay long enough to go through the opening bell with you, the first 30 minutes of opening range, and then I'm going to break session with you. But the focus for you is to determine what it's likely to do on that weekly and daily chart. And let's assume that we didn't trade down into the blue shaded area, which is that weekly buy side and balance sell side efficiency that I outlined on Monday at the beginning of the live stream. Go watch that again. It is, say it was lower still and we haven't traded down there, then I would favor something like running up here, taking the buy side and then selling off, and then using every premium array, some kind of a fair value gap, some kind of bearish order block, a bearish breaker. I would use things like that to get short to ride down into my weekly and or daily higher time frame draw on it on liquidity. So because it's already done what it was outlined for me for my analysis this week, and because it's a non-farm payroll week, it's a short week for me. Like I wouldn't be trying to do anything else. But to prove that my concepts can still ferret out setups even in these types of conditions, I'm sitting with you outlining price. But there's no trade here right now. The trade I just showed early on, that was available, but simply because we haven't got that close to the first news driver that came out today at 8:15. And if you're not looking at economic calendar, you can find that on forexfactory.com or Econoday calendar. They're both free. You don't have to pay for anything to have it. And you need to know what injections of volatility are likely to enter the marketplace. Up close candle, after running up, they left these relative equal highs here. We're trading right at the bottom of that candlestick right there. See that? So let me annotate that. You'll see it populate on the chart to the right on that 15-second. We're just hammering on the bottom of this up close candle, and I would prefer to see it use this information here to probe the sell side resting below here. We have a down close candle there, so as long as it stays above the mean threshold of this down close candle, that would be in my mind bullish. So there's the mean threshold of the down close candle. That's a bullish order block. So if it does go below here, my eyes are focused on this individual candlestick. If we trade through it and it has a close below, then, and what do I mean by that? Well, the order block is on what time frame? What's this time frame up here? 5 minute. So it would, if it lays a body down and puts it below the middle of this and it closes down, what that has done is it's breached its mean threshold. That means it's indicating that this is not a good area to expect price to stop at. It may go lower. Not all the time. It just means that chances are it's more likely that it's going to go lower than it would be if it was to just trade down into it in the upper half and never even touch the mean threshold, which is an ideal situation. But you never want to see it explore on a candlestick body's delivery into the lower half of a potential bullish order block. All right, we're back at the top of that weekly buy side and balance sell side efficiency. Still no setups. Looking for things, and what I would like to see is not an entry. I just want to see either one of these pools of liquidity traded to. I don't personally care really which one it does, but that's what we're going to be observing this morning. It's how it behaves once it trades to here, or if it trades to here, does it use the other one as a catalyst for trading to it? I should have stopped before I said I don't care. I really prefer, like I said earlier, I prefer it to take the sell side first, because that makes it good for when it goes above here. It could explore a little bit higher, but down here it would be better for it to hit it first, attack that relative equal low, and then go higher. It doesn't need to do it. It just means that for me to feel confident about reading the tape with you live and call out individual PD arrays that I trust, I'd prefer they take the liquidity out underneath the market first. By doing that, what that is essentially occurring is smart money's buying, or they would have the opportunity to buy at a cheap discount price because they're sellers below these relative equal lows, protecting their long positions. So if it trades below there, those sell stops become market orders to sell at the market. So smart money can accumulate their longs by just going in and buying that up until it's exhausted. And then once that sell side's been engaged, smart money's now on board with long positions. Early longs are now stopped out with a loss. Breakout artists that want to sell short on a breakout, they're tripped in short, so they're trapped short, and then the market will reprice higher. So because I'm siding on the daily long-term higher time frame trend being bullish, because it's an election year, because they're trying to keep the market propped up, they don't want to have an election. If you think we're going to have one, if you look at the administration that's in power right now, they don't want to have anything that looks like they didn't do well. And the public's perspective is what? the stock market equals the economy, and it's not. So that's why you're seeing this artificial propping up of the stock market, because there's literally no reason for any of these stocks to be where they're at. But it convinces the dumb money in the street that, hey, look at the economy, it's raging, it's strong, it's good. No, it's not. How much is your groceries costing you? How much is your utility bill cost you? Car insurance, it's going up, hasn't it? It's going up 30% next year too. Get ready. And that's just preliminary expectations. If we start seeing wild stuff going on, people tearing up stuff, then your premium's going to go up even higher than that. So all you guys with your fancy cars, we're going to see how long you want to keep them next year. Yeah, about it. Now, it could do something like this because we still have time. It could take the buy side. Don't run after doing that. Take the buy side, come all the way back down, and hit the sell side. And then range in between the high that it forms here and whatever low it makes going into opening bell. That would be a scenario. It's a very challenging position for me to be in on a non-farm payroll week, because I know that there's literally so many things that could cause the market to do certain things that would upset any trade idea that I or anyone else with another methodology would have. And that's exactly why I tell my students, don't touch it on Wednesday, Thursday, and Friday. Now, I'm sticking to the rules where you can trade the morning session, but when we were trading and teaching Forex, by 7 o'clock in the morning, if you didn't have your trade on, you have to be done. Like you're not allowed to do anything. So we're rolling into the morning session here, where for stock index futures, if you can trade the pre-session, pre-market hours, which is what you watch me do on Twitter, that's fine. I have no problem with that. I would never try to say, well, that's something you shouldn't have done. All right, so we have two pools of liquidity on the upside here. And there's one resting right up here. So on non-farm payroll weeks and on FOMC weeks and CPI week and PPI weeks, those reports, those events, they are going to be the weeks that, if you were asking me, like, when am I less active? When do I let a lot of trades pan by and pass by and not do anything with execution wise? It's those weeks. Barring anything else outside of those individual impactful events, again, I'll say them again. It's FOMC, non-farm payroll, CPI, and PPI. Those big high energy attraction reports or events, they use those for disruption, and they'll use those big report information that it's dumped at 8:30 or whatever, or in the afternoon for FOMC. They're used as a perfect smokescreen to justify, oh well, look, this report caused the market to go here. But when you look at the data, and if you subscribe to the view that these people use for using fundamental data, to me, you're fundamentally stupid to just look at the data, because that data is already cooked in. It's already baked in the price. So I don't ever worry about the raw information. I'm watching the level of energy right ahead, and then at the time of the news driver, releasing, and then what we see immediately after that. Where does the market go? And there's many times in my last 30 years where I used to study fundamentals. I thought for sure I was going to figure it out. And nobody figures it out. It's such a long-term thing. It's not useful on an intraday basis. So, and the reason why I say that is because the raw information that comes out with these impactful news drivers, they may be viewed from the fundamentalist perspective that this should be constructive or bullish for equities or stocks. Therefore, the stock index should go higher. That means it should be bullish, right? But what happens sometimes, more times than you want to see it, it'll go down when it should be interpreted as bullish, or it'll go up when it should be interpreted as bearish. So what are you left with? It didn't take me long to see that this is garbage and it was tricking me. And I used to have services where I would subscribe to that were supposedly going to give me the tip beforehand. So I got scammed before. I did all that same stuff you probably thought about doing, and none of that stuff works. So what I just concluded was I'm going to anticipate a lot of volatility around these reports, and if I don't have something clear cut as to where I think it's going to go on a weekly chart and a daily chart, I'm probably going to do nothing. And I'm going to do very little trading on that week. I'm going to try to focus on early part of the week ahead of that heavy news impact driver. What I'm saying is a red folder or high impact news event or report, or a medium or orange colored folder report, in deference to the people that use Forex Factory's calendar. You won't see that on the Econoday. The Econoday's calendar is a little bit more plain Jane, but the emphasis, the magnitude of how much volatility will come into the marketplace is not directly linked to the report itself. It's the fact that the hand that is in control of price, this entity, okay, we'll call collectively the market maker. They will many times move the market to a degree and have such a wide disparity about where price was before the report hits the market and then minutes after. And that's untradeable. You cannot enter in the marketplace when it's like that. And trading ahead of that is stupid. So because it creates it's an invitation to lose money, basically is what I'm getting at, when you're trading on the Wednesday, Thursday, and Friday of non-farm payroll. Now, how can you skew those odds because you want to trade on Friday non-farm payroll? You have to wait until 8:30 hits, and then after the bell opens, then you can trade it normally. But at 8:30, you should not be in the market ahead of time. No way. Absolutely not. Because it's a carnival ride. As you'll see this Friday, it'll be wild. And I've watched instances where in 1 minute, we've had 250 plus handles on a non-farm payroll event. In one candlestick, in 1 minute, prices traversed that much in NASDAQ, and you think you're going to trade that? You can't afford to be wrong if you're positioned ahead of it. And these are instances where you see the data would have been viewed as bullish or bearish, and the market does the opposite. So what happens then? The fundamentalists are thinking, well, I was fundamentally fucking wrong here. So I stick to the technicals. So when I'm looking at the markets, I'm focusing on, technically speaking, this is what I think the market's going to do. Whereas a fundamentalist would say, fundamentally speaking, I believe that the interest rates are going to cause the market to do this, and it has a very long-term macro perspective over price, which I won't argue against that. But for day trading purposes, very, very short-term intraday fluctuations, the data itself isn't necessarily going to benefit you all the time. So I just look for these impactful days on the economic calendar to anticipate the market being harder that given week. And if I have the opportunity to trade early in the week to get whatever scratch I'm trying to get, I'm going to do that. And then I'll demo trade, paper trade, encourage my students through tape reading the rest of the time. So it removes any inherent risks that I could get caught up in, because I can hurt myself in those environments because there's something in the marketplace that's cannibalizing more so than when it's not. And you'll understand that the more time you spend studying and being aware of the economic calendar when these reports are due, they're always scheduled in advance. You can look at an economic calendar for next month and you'll see where the CPI and the PPI numbers are going to be. You can see where the non-farm payroll is going to be. It tells you the very time it's being released. So they're not hiding it from you. So you can schedule all of your trading in advance, and you can also schedule when you're going to sit still and not do anything. But how much effort have you placed in that in terms of your trading? Looking for times when you simply are not going to do something where you incur risk. You probably never even thought about it like that. But that's exactly what a professional trader does. They identify problem areas. They don't want to be caught behind enemy lines when they're going to be outgunned, outmanned. And that's essentially what you're trying to do when you're trading around real close to these big news events. And non-farm payroll is a poster child for wrecking and blowing accounts. I have blown accounts using it. I have made a little bit of money, and that little bit of money that I made on it, being right once in a few times, gave me early on this insatiable desire to conquer it. And I have never been able to conquer it, meaning that I can't be right about where it's going to go before that employment data is released. I can't trust that. And I've hurt myself trying to do that. So I don't need to do that, in the future anymore, because I've done enough damage to myself. And I've learned that the PPI and the CPI number can rip your head off literally instantly. And if you're wrong, it's unforgiving. So while all those reports are tradable after they release to the marketplace, and let some time, minimum 15 minutes. Wait for the news to hit. Whatever happens for the next 15 minutes, then start studying price. And you're going to be looking for 1 minute and sub 1 minute price delivery. If you start noticing that how PD arrays are not being respected, there's no rhyme or reason why it's stopping and turning where it is, and it's just being real sporadic, that means they're still in there doing stuff. Don't touch it. Don't put your hands on it at all. And then wait for the PD arrays, like the imbalances, like the fair value gap. If it starts supporting price at the consequent encroachment, that's usually one of the real quick go-to things I like to look for, because the middle of a fair value gap is, until I taught it to you, nobody's concerned about it. Nobody's ever paid any attention to it. But when there is manipulation in the marketplace, you're not going to see that consequent encroachment being respected. It's going to eat right through the entire fair value gap. And that's indicating that what? You got to sit still. You have to just remain still and let the market settle that down. And when they stop being in there manually, you'll be able to recognize that moment when you can start seeing the precision elements that I teach my concepts to provide you. But you have to be able to see it on the 1 minute chart and under 1 minute chart. And if you don't see that on a PPI number, CPI number, or non-farm payroll day, don't touch it yet. So it allows you to know exactly when it's safe to go back in the waters. Because as long as you're seeing PD arrays not being respected at all, and they're trading through them and the levels that would otherwise stop right on the tick, if that's not happening, you have no green light to go back in or enter. There's sharks in the water, and you just got to wait, just simply wait. And it's an easy thing to do once you understand what I just gave you. It's a protocol that preserves, well, it's designed to preserve your capital, and it's also to preserve the mental capacity and equity that you have, because you can not only blow your account, but you can also wear yourself down mentally. And even though you may have equity still in your account, you have now hurt yourself and scared yourself so bad that you've made it impossible to take another trade for that day. And then when your trade really does set up and the manual intervention has stopped and precision elements are back in there, you're going to be like a deer in headlights. You're going to be paralyzed. And then when it moves, you're going to wish you were part of it. And one of two things are going to happen. It's going to go entirely to where you thought it was going to go, and you didn't do anything, and you're going to beat yourself up about it. Or you're going to chase price and argue with yourself. I knew I should have just took this, but now look what you made me do. Look what you made me do, Michael. I had to go in here and buy this 30 handles higher than I should have. If I would have just did what I wanted to do and not listen to you, and this is the internal dialogue that every trader goes through until they figure out when not to do something. And that when not to do something is a critical factor. It's a skill set that, in my opinion, is worth more than you learning how to enter good. It's better than a very small, ultra tight stop loss. Because if you don't know what you're doing and you keep trading, even with your small, ultra small stop loss, and you could be right on the side of the marketplace, your entries could be great, but your stop loss stop loss placement may not be all that sharp. You got a small stop, yeah, but you're getting constantly beat up and chopped up because you don't know to stay out of the market. Remember, when manual intervention is underway, opportunities are cleverly disguised impossibilities. It's going to look like it's right there ready to be plucked off the vine and enjoyed. But as soon as you grab it and you pull it, a snake's going to bite you. And that's exactly what happens when there's manual intervention underway. So I'm telling you that because you want to be looking for that after we get through the morning session of Wednesday, this morning today. Start looking for those elements in price action. Especially start looking for it like tomorrow at 8:30. There's employment data that's being released, and then there's the actual non-farm payroll released on Friday at 8:30. Watch the 1 minute and the 15-second chart on your own. Don't just listen to what I'm jawboning about. Watch and see. And you'll see either an absence of the precision, which means that they're in there still manually intervening. They're moving price around where they want. Whereas any other time, it's just AI driven. It's just doing its own thing. Scripted. When they're in there moving stuff around, they're not going to move the price right to the tick. They're going to raise it up to take out a high and go way beyond what you expect it to go to. And then, or drop it down way below an old low, and they're not going to lay that low down on top of anything that would be precision. It's just going to be a big abrupt move. And that's the stuff that hurts you. And it's also the same types of things that cause you to have unrealistic fears. Because these big, wide tidal waves or tsunami type price runs that just completely decimate people if they're on the wrong side of the marketplace, they don't just hop out in front of you all the time. They're occurring around economic weeks that have these big news drivers. So it's like a hazard sign. You drive around in the mountains and you see these signs that says, falling rocks. Does that mean that the rock's going to fall on your ass right then and there? No, it doesn't mean that. But guess what? It could. So be mindful of it. Just be aware. Start having a little bit more awareness of, do you see little plumes of dust ahead that maybe a smaller rock has started to fall before the bigger ones are starting to come down behind it? So it allows you to prepare for rough terrain by looking at your economic calendar, knowing where these medium impact and high impact news drivers are in the week that you're about to trade or in the present week while you're trading. You're informed as a trader if you know this. And now you know how to see when they're in there manually intervening. The market conditions ahead of non-farm payroll is what you're seeing here. This is typical of non-farm payroll. It's just range bound. It's just listless type trading. It's wonderful study material. It absolutely is wonderful to study it, but it's not enticing enough in the beginning for new students to stick with it because they want to see dynamic big price runs. They want to see their little indicators, give them their entry, and it runs 100 handles, and they can go show what they made on social media. You need to strip all that stuff away when it's non-farm payroll week, because ahead of that number on Friday, you're going to see a lot of this range-bound stuff. And now it exasperates this likelihood when you have things that's going on in the Middle East, because the hand the market makers, are formulating strategies right now how they can hurt people with what's going on over there. And how can they unseat somebody to make money by that happening? That's what's going on. So when the market's being held like this in this range, it's not because there's a lack of buying and selling pressure. It's not because there's a lack of interest in trading. It's not because support suddenly starts working and resistance starts working. It means that they're holding it here and they're engineering market sentiment. Means they're controlling and influencing, let's say it that way. They're influencing the expectations of investors and traders. Because as long as we start working towards these higher highs up in here, anytime we go above it, what do we feel? Oh, I wonder if it wants to keep going higher. And less informed traders see that as, oh, it broke out. That's resistance broken. It's going to keep going higher. And anyone that's done that thus far, they're sitting in this drop down. And they may have gotten excited when it rallied up like this, but then dipped down below relative equal lows. So you want to spend a lot of time on non-farm payroll week at Wednesday, Thursday, and Friday, and try to put yourself in the seat of a retail trader. Like, how do they trade? And it may be even beneficial for you to put like an overbought, oversold in here, like stochastic or RSI or CCI, maybe MACD, something like that. And you can see visually when traders would use that information and how it will get them in trouble. So by basically arm wrestling the things I teach versus the retail perspectives using indicators and whatnot, time of day, the opening range gap, the opening range, all those things that I've been teaching you, if my tools are saying it's going to behave a certain way and go a different direction than that of an indicator or some kind of retail school of thought, you have a wonderful experiment to see which one actually is giving you the truth at that moment. And it's extremely illuminating, because it feels like, and I've seen so many I've seen so many people in this mentorship since we started this year. I don't feel like I should know this stuff. That's a common theme that I'm seeing in either comments on Twitter or it's comments left on my YouTube videos. So, all right. So here we're at 9 o'clock now. Okay. So now we have primary buy side and primary sell side that we can identify. And that is going to be seen with, I'll just borrow this one because it's easy to do it. So we'll say this is primary buy side, and that's because we've already cleared this over here, and higher than that would be over here, and that's a little bit of a ways away. So we're just trying to stay close to where we're at right now at 9 o'clock. Close proximity. Where's the liquidity at? Well, this is where we're at right now at 9 o'clock. So where's the high? It's that one. So you have minor here, and now these lows down here, they would be primary sell side. Not complicated at all, is it? This guy complicates trading. You are a lazy ass, and you're looking for any excuse because you thought it was going to be easy. And this ain't easy here. There's an expression. If it ain't rough, it ain't right. Anything worth doing isn't going to be easy. But when you have the skill set, you're going to be in that small little percentage where people, they have to use things like, oh, you're part of a cult. Oh, you're all brainwashed. You're brainwashed. You can't talk to these people, these ICT people. Well, yeah, once we know what we're doing, no one's going to be able to come here later on and say what we're doing is not the right way of doing it. It doesn't, no one can come here and say, you're not equipped now. They arrive too late. Not today, Satan. All All right, so we have a primary buy side, minor sell side, primary sell side. We're trading at the top of that weekly buy side imbalance, sell side inefficiency. We've had a sell side imbalance, buy side inefficiency traded to here multiple times. Let's do a tape reading on this little run here and see if it'll give a fair value gap once we start to break lower, and then see if it can deliver to the minor sell side. Okay, so you have a fair value gap there. Hit one here. And you have one here too, it's a small one. You should be able to see it like that. Yeah. So now when you have two fair value gaps like that, what do you think? If you saw this one first and you were ignoring this one, think what I taught in the model 2022. You have to allow for price to reach up into that second one too, if it's good. And now I'm not saying it's good. See how it went into the second one? So if you were using this one as your entry, thinking that it would go down to the sell side here, and you didn't allow for price potentially trading up into the upper one, you would have got smoked immediately because your stop loss would have been here. Using this fair value gap, the stop loss would have been right above this high, this candlestick's high. But here, we have this fair value gap. So you have to do what? Make allowance for either waiting. There's just two schools of thought here. You can do the entry here and then use a wider stop loss, which I know some of you don't want to hear that. Or you can wait for it to trade there and then see if it wants to stab up into that one, and that would be your entry. And then you can use a little bit larger stop loss that would be more forgiving up here. In the beginning, it's real hard to talk to students and encourage them to use a little bit wider stop loss, because you need that extra forgiveness, because you're watching someone that can do things real precise. And it's like anything else. As a little boy, I used to watch Spider-Man swing around and do crazy stuff, and I thought, well, if I go outside and I put my ski mask on as a kid, and I'm going to run around with my underoos on, I could climb over cars and jump off of buildings and land and not hurt myself, until I tried to do it, and then I hurt myself. So you got to give yourself a little bit more flexibility and forgiveness in the beginning. So you're not going to be a web slinger in the beginning. You're going to have to be a little bit more slow and allow yourself a lot more flexibility, and being less accurate, more likely to do it wrong. Right here. That neutralizes it. The other thing I find hard teaching new students is using the lowest leverage. They don't ever want to listen. They don't ever want to listen to that. They want to use the biggest leverage. And it's because they're being influenced by other people. And I'm sure I have some measure of influence over them too, because they see what I'm doing in my examples. If you can't find consistency and profitability with just one contract, even if it's a micro, you're not going to make more money when you're trading with larger leverage. Okay, so that would cancel this one. Now with the market trading below this low here, inside that weekly buy side imbalance, sell side inefficiency, this inefficiency now, if it trades down to it, if it trades to it here and sends it back higher, any future fair value gap that would form after it trades this and sends it higher, that could be a catalyst to send price back up to primary buy side. So in this case, this fair value gap that we were watching and doing a case study on, this could potentially be what? Inversion. So now you can study it this way. You don't want to be doing the demo entries on non-farm payroll week on Wednesdays. You tape read, because if you're doing actual pushing in the buttons and seeing stop losses getting hit or targets getting hit, you're tricking yourself at the worst time. You're feeding yourself bad data, basically what it is. But there's nothing wrong with going in and just watching and observing price instead of just blindly staring into it and thinking, okay, what's it doing? If it starts moving one direction real fast, I'll chase it with a demo entry. That's the worst thing to be doing. And most of every student I had for Forex, that's the perspective they had when they came in. They're like, why aren't you short now? When I'd be live streaming and it had gone up like 15 pips, which is nothing, it's insignificant, right? But they'd be like in the comments like, why aren't you long here? Why didn't you go long here? I'm like, there's nothing to do. We're literally observing. There's things in motion. We have to wait for it to provide more information. You're sitting still for a real reason, basically, not because of ignorance. You want to take high probability, low risk entries. All right, now see what we did in here? Came back up, showed no willingness to come off of this to show displacement. Is that a losing trade? No, because the idea was what? It has to go down to it and then start sending price higher. And then after it starts to rally, a fair value gap that would form then would be used. Not, oh, it's going through this inversion fair value gap. They don't hold. It wasn't supposed to hold. It was supposed to stop, then allow price to run away. Then the fair value gap was to form later on. All right, so now this becomes its original when it was a sell side imbalance, buy side inefficiency, below price. That is a classic bearish fair value gap. If it trades up to it here, it becomes what? A reclaimed bearish fair value gap. And the focus is here. Volume imbalance right there. Watch that one too. So we could jump up, redeliver, and do patchwork in here, and maybe spike on a wick to the bottom of that fair value gap, and then see if it wants to run to the sell side. You're inside the volume imbalance right now. That's this separation right here. Remember, all we're doing is we're studying all of this range-bound price action. We're just studying it over the lens of a 15-second candlestick. So here's the volume imbalance. If you remember being in school, like in chemistry and physics and whatnot, I had engineering classes and stuff. When we were in class, we always had these experiments. We had laboratories, basically called it. And you had the ability of sitting in, and usually you had a partner or you had a small group of other students. And we were doing some kind of observation. We were doing tests. We were measuring the incubation cycle of chicken eggs. We did all kinds of stuff in school, and that's why science and math were always exciting to me. English, I sucked at. Everything else, I sucked at. But those studies were that's my forte, and mathematics was my go-to. And when we're looking at price action, the closest thing I can try to encourage new students to do is treat your study of price action like a laboratory, like a case study of you doing like forensics on it. Like, what's the fine details in here? Okay, and when you listen to people like Anton Creel from his little stint when he was a reality star for the BBC, his stuff that he puts on YouTube will say, and I'm sure it was directed to me because I was really making fun of his blue suede shoes one time and he blocked me. But he says we're not doing technical science here, and that's what I was like. You know what? That's exactly what we do here. Okay, so I took that from him. He used it as like a ribbing, like an insult. But I was like, you know what? That's a badge of honor. We are absolutely doing technical science here. So you're really going in price action and watching, and does price continuously give feedback that would be measured as a pro or a con for a delivery of price action? Are you seeing the things that you would expect to see if it was going to be a sustained price run to a high or an old low? And you're constantly looking for these things. The main takeaway, we're at the top of that weekly buy side imbalance, sell side efficiency, and it can touch again that volume imbalance. But what happens if it spikes up with a wick and hits this and then drops? Is that something that's bad? No. It's something that's reasonable given the type of climate we're in this week. We are past the easy days of this week. That was Monday and Tuesday. So Wednesday becomes what? Harder. It's going to be a lot more challenging for you. If you don't know what you're doing, it's going to be very, very challenging for you to be able to see what price is going to do next. Think about that in terms of when you read these books that people write, or they have courses, or they do mentorships, or they have live, analysis and signals. If they are not emphasizing and using terms like this is difficult right now, or they're not describing, and I'm not saying that they're not saying something useful when they say, "Oh, the market's just going nowhere right now." That's a realistic observation, and I could say it's good. But when they just conveniently say, "Oh, it's just choppy right now," that's like it's an escape mechanism for them. Instead of saying, "I don't know what the market's doing right now." How hard is that? I don't know what the market's going to do right now. You're going to hear me say those things when the market is having intervention, when there's the hand in there moving things around, that the algorithm is no longer in control of price. They are pushing and manipulating price. Well, then I have no idea what price is going to do then. And why should that be upsetting? You would expect that, right? So see this up close candle here in that volume imbalance. My eye goes to this every single time. Every single time I want to put an annotation on it, it jumps. Come on. I'll fix it when I drag it over. Right there. All right, and then that would be this. See, normally when you're above that buy side imbalance, sell side efficiency, coming back down into it, it's acting as what? A bullish fair value gap. That's its initial classification. But if it trades down below it and you're bearish, this becomes a inversion fair value gap, and you want to see things treated to heaviness. You want to see price remain heavy at the midpoint of it or to the low of it, and not explore the upper part of it. But having an understanding of where you're going to have difficulty, and not having an ego about being able to admit either to yourself in your journal where nobody sees that. There's a volume imbalance right in here. It's just repricing back to that. The implementation of social media for traders is cancer. Like you're making everything so much more harder for yourself if you don't know what you're doing. Like I get out here and I clown around, I troll, I do a lot of stuff. Sometimes it's very subtle, you don't realize it, but other times it's obvious. The Some of my newer, younger male students, they want to emulate me in that regard, and that's the part I don't want you to want to do because that's just me doing things to ruffle the feathers. You want it because you want to feel like you are the main character, and if you remove all of these instances where you don't have to be fearful of admitting that you don't know something right now, and it's important for you to recognize how it is that you're going to be incorrect. Where are those instances where looking at price action and not knowing what it's likely to do and observing that you are now met with the difficulty, the task is next to impossible at that given moment? Why would you want to sit in front of your charts and press the button? But think about it. I guarantee you, you can remember times where you knew you shouldn't be doing what you're about to do. And that's exactly when you blew your account. That's exactly when you had your largest losing trade. That's exactly when you lost your funded account. You blew your combine. Something happened where you have had the worst possible outcome that could have happened at that given moment. But you knew going in that there was something going on in price that you didn't quite understand, but you just wanted to fuck around and find out. And you did. Now contrast that with the way I teach. I have a long way around the barn. I do a lot of talking because I'm talking to my kids. I'm counseling them. If they ever come to me with a question, they know what's going to happen. I'm going to give them an hour answer because I want them to understand the ramifications of subscribing to the view I'm going to give them, what the pros and cons are going to be, what other people are going to say, what they should see from doing it, and then reminding them that you're probably going to get a different outcome too, but you asked me for this, so there it is. And Caleb will tell you, like, I know if I come to you and I ask you a question, I have to make sure I've made time for this because you don't ever answer things short and sweet. And it's because I want them to understand my answer, not just, Dad, what do you think? Well, grass is green, the sky's blue. Okay. Now, why the fuck is the grass green, Dad? And why does the sky look blue? And I go through the process of explaining all that stuff. So that way they don't just say, Dad thinks this, Dad believes this. No, Dad knows his stance on this based on this is what he told us. And that's why I do what I do in the descriptions of price runs and how to formulate this routine of reading it. There's going to be times where, even with my information, my concepts, it's not going to work out for any of you. So, isn't it beneficial to know when that's likely to occur? To ignore it, to pretend it's not going to ever happen, is a myopic perspective. Like you're asking to fail. It's been too many times coming back up to that volume and balance. And we're about 8 minutes away from the opening bell. I wished I would have been more interested in spending time finding my faults where I was initially trying to hide them from myself, and I would punish myself in my journals. I would really, it would be very jarring. It felt like therapy, cussing myself out in my journal. And as I wrote it out, I'd feel, sometimes I would laugh to myself like, that's right. Yeah, you deserved everything I just said to yourself right there. But then once I'm done and I'm going and doing something else, taking a drive, working because I had a job then, I would think about what I said about myself. And I'm thinking to myself, man, if someone else said that about me, that would make me feel terrible. And I'm doing it to myself. And then as soon as I felt that, I dismissed it real quick. So what was I doing? I was allowing demons to fester, and I'm letting them make home in my mind, in my thought process, and it's extremely toxic. When I started looking at things that would helped me not think that way. And I didn't hold myself up to, I have to be perfect in my expectation in the marketplace. I have to see these things every single time, because I saw a pattern of me getting it right and my concepts were starting to flesh out. But then I would have these instances where nothing was working, like nothing made any bit of sense. And the market would just behave in a manner that was erratic. If we get below here, because I could still say no thank you, but right below these lows, this chart on the left hand side is a 5-minute chart. So below that is minor sell side. That it's at 19,924 ish. So if it goes below that, I would be interested in seeing a lot of speed to get down to upset the sell side here. That's still good if it wants to go higher. It doesn't change it to make it bearish. It just means that would be a logical place for it to dump at the opening bell. And then everybody think, wow, it's really bearish. And then they start sending it back up higher. That would be a wonderful opportunity. I would manipulate price like that if it was me. That's exactly what I would do. But I'm not in control of price, so. But the observations that I started making and looking at where my journal entries were extremely toxic, like really, really toxic. Bad days, upper right hand corner of my journals, I'd have an X. That was my way when I was going through, because everything I do is handwritten. Like I don't do electronic journaling. You all have the advantage of it today, but I didn't have that technology back then in the 90s. So I never wanted to transition from the high touch of journaling with a pen and leather journals to doing it electronically. I don't have the advantage of going and like sorting and searching for things by keyword or date. I don't have that ability to do that. So if I want to go back, and I can remember certain months out of certain years where I had really, really wonderful instances of things panning out wonderfully for me. But I also have very, very, very bad memories where I know generally I have some of the dates memorized because it's traumatic. Sometimes I forget my own kids' birthdays, but I can remember the days where I lost a lot of money. And when I was experiencing that stuff, obviously I would journal. And then at the top of the page, upper right hand corner, I'd have an X there. So whenever I wanted to go through days that were, there's your run to the sell side. So you want to be able to journal that. So we were looking at it up here, top of the buy side and balance, sell side efficiency, inversion, fair value gap, the volume imbalance, hammered it one more time, and then delivered to the minor sell side. So these are all the things that I was fleshing out early on as a 20-year-old. Like I was trying to figure out how I could bridge the gap between what I understood about how price was transitioning to 100% electronic and no more open outcry. How can this be bridged? How can I see price in a manner where electronically it's going to deliver to here? But the market never does. Well, let me not say it like that. Rarely does the market ever do things like move from where we first started watching and observing and looking for it to go lower. It never just simply does a drop straight down from where you see an entry potentially at, from the time you see an entry, and this is where you think it's going to go. In your mind, as a new student, you think that, okay, my entry's here, so now I expect it in one candlestick to go right down there. And if it doesn't do that, every new candle it creates that hasn't really rushed to get down there feels like an eternity. So you have to learn to submit to time. And what I would do in the early stages of my development when I was codifying all these concepts is I understood that the market was going to go to this liquidity. I understood that part. But I had to have a way where I could see multiple instances of where I see a setup forming and where the market could go to. Okay, that's my range of opportunity. That range of opportunity needs to be defined. What do you mean by that? It needs to be defined. If I know that there's liquidity below these lows over here, then it's not just getting to that price point is the objective. It's to get to that price point and then below it, because it needs to engage that liquidity. So if I see this volume imbalance as a initial inception of a price run, and this is a terminus to liquidity, that makes sense. You all as my students, even if you're brand new, if you were watching just this stream for the first time, what I just explained, you may not know the volume imbalance of what the mechanics are around it. It's not necessary right now, but if you think that prices are going to move from that level down to this level because there's liquidity there, then we have to consider where is the ideal entry points, and at what point does the probability being high diminish from being high probability entries to lower probability entries. And that's where I ring in the premium to discount. So if I highlight this, and no, I don't want to do that. Let's do it like this. From the entry to where I believe the terminus was right below that relative equal low here. We have one more minute now. I'll finish this real quick. Here is the equilibrium price point. So at that price point or above, anything that could be used as an entry is a premium. Notice how everything below it, you don't want to use as an entry because you're so close to where it's going to go. But look at the volume imbalance. It's in a premium relative to the midpoint of where you believe it's going to go and where you believe the inception of the move begins. This is your point of interest, that PD array. That's where the inception of the move, the beginning of the move, and the terminus is where you think it's trying to reach to. So by framing that, every time you take a trade, you have to know where it's going to go. Your target, that's terminus, and where you're trying to get in at. And then from there, you frame where premium and discount is. Discount is below. If we're trying to sell short, you can't sell short in discount. You got to sell short in premium. Right back to inversion fair value gap. All right, opening bell. The fireworks have started. Sorry, you're probably going to hear my wife coughing. She's gotten sick because of my youngest son, him being sick. So keep me in prayer because I don't want to get that crud because they're fighting some nasty stuff. Let's do regular trading hours. All right, so we have a discount gap. Take this stuff off here. All right, so we have a rather every single time. Every time, man. Yeah. So mid gap is right here at 19,965. So again, 70% of the time, the first 30 minutes, that usually gets traded to. And now we can go back to electronic trading hours. And we're looking for the potential to run down into primary sell side. This little gap in here, that might be a speed bump if it gets down there. It doesn't mean it has to go down there. Let's go to a 1 minute chart on the left hand side. Okay. Now remember, the opening gap is the initial bias, Caleb. The first 30 minutes. If you gap down that first 30 minutes, your primary focus is looking up to the midpoint of the gap. That's over here. That's this price level right there. And boom, there it is. So once again, you're seeing those odds I tell you about panning out. if you look for ways to trade turtle soup, one of the things you can practice is if you have the opening range gap and it is at least 40 handles or more, that's like my minimum, for interest on the first 30 minutes. If it's a larger gap, then I'm really interested on the day, and I'm going to try to most likely do most of my leverage that can be afforded to on that given trading day. 75 handles, opening range gap, that's really good. But here, every single day, if you have 40 handles or whatnot, you have a range to trade that first 30-minute opening range. If we gap down, it can trade up to that mid-gap price level. If it does something like this, where we've already identified minor sell side, and we have a low like this, trading down into it like that, you can do a buy on a stop, where it allows the market to put you in. Anyone that would look at turtle soups like this and think, man, how do you know where to buy? There are instances where I can be buying below the low, but other times, like today, I was looking for an opportunity for it to see if it could go a little bit lower. But if you want to trade turtle soups using the opening range gap mid consequent encroachment level as a draw for that first 30 minutes, when it breaks below the low like this, all you have to do is take the candlestick that right before this candle low was formed, what candle pierced it? This one. So if you take that and you use the open of it, if it's a down closed candle, what are you essentially doing? You're identifying an order block, but you can trade inside that candle and use its opening price to buy on a stop. So then you could be a buyer here, trade up to the opening range gap midpoint, consequent encroachment, done, you're out. Small little high frequency trading entry, and back test it. You'll see it. It's many times a wonderful way to trade turtle soups. That's a mechanical entry, very, very mechanical. Because if the market kept going lower, would you have been filled? No, because the buy stop would have never been triggered. So it has to trade to that price point, and then once it goes to it, it kicks you in just like a stop loss would be. If you were short, it would knock you out. Well, in this case, because you don't have an existing position open, what's the mechanism behind it? You're buying from a position of flat, your sideline, but now the only order that's executing is when price trades to that opening price, it would trip you in long because it's a buy stop. And then once that occurs, you ride it to the mid gap, which is what you see here, and look at the price has done since then. You think that's random? Mid gap, drop down, now aim for the sell side over here, the equal lows. Remember that show in the 80s, Mr. Wizard's World? One of my students said, you're like our version of Mr. Wizard. Some of you young guys and gals out there probably don't know what that is. Just Google it, you'll see. So I used to watch the show too. It was neat because he would do like these little experiments. He'd take baking soda and put it in this little thing here, and then you do this and do that. And something that your mom would come home and see you mess around with after school, be like, "What the hell are you doing, Michael?" I'm just doing what this guy on TV did. What the hell? Why do you have my shit out here? Put that stuff back in the cabinet, and I'd be in trouble, right? But that's what you need to do as a trader. You need to study, get in here and tinker around and see what these little candlesticks do together, how they communicate, how they behave with one another. All right, I'm going to take this line off because it's no longer salient to us. It was just marking the first initial minor sell side. All right, see how we dug into this gap here with this wick? If we can roll over and trade below that low, it should, if it does so, it should have speed to drive down to that area here with the relative equal lows. I'm watching the wick on this candlestick right here and its halfway point. Now this is a little bit of a cloudy delivery where it's not as clean, it's not real efficient, but it's better than it was the other day. So when we have less impactful news around the days that we're watching price action, you're going to see how price is just so nice. It just creates these really clean price runs. See how many times it keeps coming back, back and back and back and back and back. Still reaching for where we're looking for it to go to, but still it's spending a whole lot of time painting candlesticks, overlapping the previous candlesticks range, going a little bit lower, but still staying inside this group of price ranges that are pretty much the same things. That is not a market that I love to be in. That's what you want to see right there. Okay, see that? So we have consequent encroachment, mid gap up here, inversion fair value gap here, consequent encroachment there, break down, then the gap, consequent encroachment on this wick right there, stopped price, went lower to the sell side. And that would be your laboratory for the opening range. It did the 70% strike rate of hitting the mid gap. So opening range gap, it went to half of it, which is up here, and then used it for what? That was your turning point to get down to where we're primary sell side. So here's several things that you can view. I gave you multiple instances of how you could trade this, the very specific mechanics behind it, where the entries would be, where it's going to draw to. Any one of these instances could be your model. Every single one of them are all equally effective. Not one of them is any better than the other because it's what you do with these setups in your own hands. Once you get good at it, like you spend time years from now, like 10 years, 15 years from now, you're going to be able to see a whole lot more setups where I'm sitting here casually talking to you and I watch what it does here, watch it. I can see the setups, but I have to teach in a way where I'm not trying to convince Caleb that there's something better than what he's trying to focus on. I have to be neutral, but still point out, no, watch what it's doing here, watch what it's doing here. And it's fun. Like to me, it's like meditation. And when you can see what it's going to do and you get to experience how it behaves after it does it. And then when it delivers where you think it's going to go, it feels like time travel. It feels like many of you students are now saying it feels like I'm not allowed to know this. Like you feel like you're expecting to knock at the door, right? Like someone's coming here, hey, we need to have a talk with you. So, and I get it, I understand. Let's use that reference point from up here at the inversion fair value gap. Let's say that you were looking for once it broke lower down here, if it comes back up and hits the inversion fair value gap, if that was to occur, you would use that as your point of interest, the inception of the price run. Where is it going to run? We were pointing down here to relative equal lows. So if you're aiming for the relative equal lows right there, can you see how at that midpoint, that's equilibrium to the price run? So you're basically, you're grading, is what this is called. You're grading the unrealized dealing range. It means it has not delivered down here yet. But you can anticipate where setups are going to form. So for the question that folks are asking, how do you pick the right fair value gap? How do you know that? Well, the inception of the move is here, dropping down. If it breaks out, if it breaks below this low, we know that there's a stronger likelihood it's going to reach for the relative equal lows over here. But how can we enter? I took the initial minor sell side liquidity line off and I said, no, we're trading right inside this gap here. If you look at that, where is this gap in proximity to the 50% level of point of interest, terminus, where you think the market's going to draw to? It's in the upper half, right? So that means this is a premium array. You can't look at this and say, how's this a premium array when we're this far away from that high? Because you don't know what the fuck you're talking about. And that's exactly what you see these yahoos on YouTube doing. They're trying to talk with my terms, but they have no understanding about what it is they're doing. And that's why their students are not making money and they're quitting, and they go and they find another ICT mentor. They find another ICT mentor. And they're ignoring daddy who's doing this for free, literally explaining it right from the source. But you don't want to, he talks too much because I want you to know everything about it. You think I would shortchange my own kids? Because I'm going to go through the process of teaching it. I want to make sure I never have to have that conversation again. I've exhausted it. So I use every bit of the available bandwidth when I'm teaching something. If I have your attention, I'm going to hold on to it and grab it by the throat. And you're going to learn it the right way, whether you like it or not. Or you'll turn the video off and be stupid. Okay, it's your choice. But knowing where the market's going to go and where the inception of the move is, that's how you frame premium to discount. And then what you can do is, with that information, everything relating to that information that you're getting in terms of premium to discount, you can anticipate without even having to throw a fib up here. You can visually see that from that inversion fair value gap down to the relative equal lows, halfway point is generally that low. So if there's a fair value gap above that, well, you have one here and you have one here. So if this was the first one you saw, but then you looked and saw this, what does that mean? You could use this as your entry, and that's exactly what the bodies are doing here. You see that? But the higher one, you have to allow for what? It to stab up into it. Model 2022 logic. This is a breakaway gap. There's no need for it to go up to the third one. The third one is a breakaway. It means it's showing its heaviness. This is one it could trade to. This is one it's most likely going to see the body stay inside of it, and that's what you see here. See that? So yes, we wick up to the higher one. We don't even bother going into this because this is a breakaway gap. This stops the move. It's ideal if it stays in the lower half. Look real close. Did it stay in the lower half? Yes. Is the rules repeating over and over again? Is the logic still there? Yes. That's not buying pressure, stopping that. The buyers didn't say, well, let's all collectively stop having any interest in going higher. Because if you look at your level 2 data, you yahoos that keep saying, show me your level 2 data, show me this, show me that. Why the fuck didn't the orders get up here tagged? Why didn't they get there? There's orders resting there, right? Because it doesn't give a fuck about those orders. It's saying, no, you're not important. But Michael's logic is important, and we're going to follow what he said. It's almost like I know what I'm doing. It almost knows like it's dead. So the bodies trade up into it, and the bulk of the volume is shown in the bodies. The narrative is determined by what the bodies are telling you. But the damage, where it takes the unlearned, the people that are unskilled, the street money, they are the victims inside the wicks. Smart money is tracked by watching the bodies. That's what's occurring. So when individuals in the capacity of a smart money trader, when they're trading price, they're focusing on the bodies of the candles. That's what they're following. All of them are following the same logic that I'm showing you here, but they're not concerned about this because they know that you're all cannon fodder. All of you, without having this information, you're all cannon fodder. That means you're going to get blown away because you don't know it. You're brought up in this industry right from Jump Street with ignorance, with everything that's taught to you with retail stuff. You're literally being fed poison and you don't even realize it. And they put a little bit of sugar on it by allowing influencers to do certain shit. And then you think, wow, I want to trade whatever the hell it is that's, you know, exciting right now with people putting fast cars and girls barely clothed and whatnot, rented villas. And you think, wow, I could have that if I traded with their bullshit. And it's easy. All I got to do is put it on my chart and just tell me if it's going to be a buy or a sell. And it's not important. That doesn't make the market go up or down. And having this understanding will change everything about what you're doing. Just take a peek over here on this 1 minute chart. Okay, we cleared primary sell side, went to the lower quadrant of the weekly buy side and balance sell side efficiency. The remaining portion of the gap, that means anything above here, there's buy side resting right there. So they're going to make a run for them. All of these gaps over here, now because you're part of what? This is part of the sell side of the curve. All this drop down. Now we're going up. So look at this like a rock surface of a mountain, okay, or a rock climber. If it wants to go back up and run for that buy side up here, it can use all the reference points over here as footholds and handholds to pull itself up to attack that buy side. It doesn't need to do that, folks. It can go straight up and just run right for it. And that sometimes is what you'll end up seeing in days and weeks of non-farm payroll, where it just runs away to get the stop. And it doesn't really give you a chance to get on that last little bit of a move. That's also characteristic of manual intervention. It's also characteristic of non-farm payroll weeks, where if you're a new student of mine and I'm teaching you how to use PD arrays, and all of a sudden you see this big sudden run, boom, it just takes off and goes right for the stops. You're going to send me an email. You're going to send me comments. You're going to say, but look what it did here. It didn't do anything and I can't see. Right. And that's because the characteristic of the market being manipulated, it's not affording anyone to get in on that move because they're running for the stops. And if you're a brand new student, that's a very hard thing to communicate and to understand, because it's like, wait a minute. Like, I'm looking for patterns. I'm looking for something to get into a trade. You're talking about how people's stops are being targeted. This sounds like conspiracy theory. And that's why they let that type of thing go out in the public. They keep people in there churning the water, saying, oh, they're not going after your stop. Oh, they're not targeting your stop. Are you nuts? Like, seriously, that's exactly what they're doing. Like, they're doing that all the time. That's the lifeblood of the marketplace. Like, without liquidity, nothing's going on. Nothing's going on. No one's trading. No one's getting filled without liquidity. You can't get your long on if somebody ain't willing to be a seller. And I can't get my short on unless somebody's on the other side trying to be a buyer. That's liquidity. That's what makes the markets go around. Okay? But that liquidity is scheduled to be taken in at a specific time of day. It's scripted. And the algorithm doesn't need to know how many contracts or how many lots in Forex are resting above or below relative equal lows or individual highs or lows. So anyway, I got about 8 minutes and then I'm going to cut bait with y'all. It's fun when you sit down and you just lay down all your preconceived ideas about me as a person, whatever you think you know about the markets, and say, let me just listen to this man and let me hear what he has to say. And then watch what I point out in price and how it should behave and how it should deliver. And you think about that. It's like, wow, there's no excitement. There's no concern for being incorrect about it. And we're all just watching price deliver. And we're looking for signatures in price action that are repeating. And if there's something that you're seeing that's repeating over and over and over again, that's the stuff you're supposed to be writing down in your journal. The things that you're having the questions pop up in your head about, that's the early onset of you having a model fleshing out in your own hands. It may not be the fair value gap. You may be seeing something else. Don't go on to Twitter and say, hey, I'm paying attention to this and this is what my eye keeps seeing. Because really what you're asking for me to do is co-sign and say, yeah, I see you. I recognize you today. And to give you like the attaboy or that girl, and that way then you can start doing videos and say, yeah, ICT co-signed this. He gave me the approval. He touched my shoulders with his sword and now I'm knighted. Okay. If you are seeing something in the charts, just recognize it and start observing it. Record it, journal it, screenshot it. When you see something, even if I'm not talking about it, screenshot it. And real quickly, just send yourself a text message or whatnot about what it is that you want to do more research on, but still watch the live stream live. If you have the ability to watch it live, there's nothing better than that. For folks that can't be here live, you have the next best thing because the recordings are never edited. I can't edit them. Once the live stream is done, YouTube has it, and they're never ever they're never augmented. There's never ever any kind of change to it. Now I might change the title and add something after the fact because I might include something in the discussion, but the content and the things I say during the live stream, they're never changed. Either I'm right or wrong. It does what I said it's going to do, or it's not going to do it. And or whatever I said is how it is. If I make a mistake and say something that was mislabeled, which because I'm not using a script and I'm doing it live and I'm doing it over very, very low time frames, I'm human, so I'm going to make a mistake like that. You don't realize how many times I'm making a mistake saying things in the pre-recorded videos where I have to go through and edit these things out. Sometimes like in the pre-recorded videos, you never hear me cussing because I never wanted to have that part in those pre-recorded videos. But you can hear I cuss because if I see something and it makes me think about how I want to discuss something, and then because I'm thinking about how I see people literally talking out their ass, they have no idea what they're talking about, or they'll misrepresent my concepts or me or my students, or say that this stuff doesn't work. Like I'm trying to throttle them because I'm literally out here proving that they're idiots. Like they're idiots. Anyone that says that this stuff doesn't work at this point now is someone that should not even be listened to. I don't mind being trolled and have a jab at me once in a while. It's fine. It's fun. But if you're going to stay here and you're constantly the same guy all the time saying that didn't happen, you didn't do this, you didn't do that, you're not watching the streams. You're not paying attention to it because I'm calling it, I'm outlining it, how it should deliver, where it should go, and you watch me doing executions now too. With one contract, $3,800. One contract. So if you were trading with a $10,000 account, that's 38% with one contract in one fucking day. Didn't do the math on that, did you? And that was just me playing around. Just playing around. What happens when you do that 5 days a week? London session, New York session, trade the lunch macro, PM session, last hour trading. 400%. Come on, that's a fucking 2-day holiday. Get the fuck out of here. So in the final minutes, I want you to think about how you have to start scheduling low energy input during the times where there is high impact news drivers like the non-farm payroll that we're going to have on Friday. Thursday and Friday of non-farm payroll, they are a no-touch day if you're brand new. Don't even touch it. Don't do nothing. You can trade the pre-market session before 9 o'clock on Wednesday. But as soon as we get to 9 o'clock, if you haven't had a trade, don't do anything. If you're a new student, don't do anything at all. I want to see it run from here up to mid-gap and expand higher. So mid-gap is this red level here. And above that, we have primary buy side. So I would expect that to be the draw going into lunch. All right. So, but I want you to think about how you can go into your economic calendar, study that, and look for high impact news drivers, not the medium impact ones. Medium impact news drivers, they can be traded. That's not a big deal. The high impact news drivers, if they are, again, in closing, FOMC, they're usually the afternoon events, 2 o'clock, 2:30, two-stage delivery. Then you have CPI, PPI, non-farm payroll. They are 8:30 delivery. So you know what time they're going to occur. If you look at the economic calendar, you know every single month what day they're going to occur. So all you have to determine then is when in the week are those days of those reports being released. If it's on a Thursday or Friday, then you know that their best trading is going to be on Monday and or Tuesday. If the report is on a Monday or a Tuesday, that means you do nothing at the beginning of the week, and then you'll have salad days, easier trading as the rest of the week trades on. But you have to see where that report lays inside of the week. Is it on a Monday? Is it on a Tuesday? Is it on a Wednesday? Is it on a Thursday? And is it a Friday? And how that lands on the calendar, what day of the week it falls on, will help you look at the information that I put in my 2017 mentorship lessons, where I teach the weekly profiles, how the weekly candlestick will paint. And by using the economic calendar, you can kind of like get a feel for, oh yeah, if I'm bullish, generally on a higher time frame, and then I see a CPI, PPI number, or like this week we have non-farm payroll. So we've already satisfied the move going down into this blue shaded area, which is that weekly buy side imbalance, sell side inefficiency. Just watch the first 15 minutes of Monday's live stream. Okay, if you watch that, you'll see exactly what I'm talking about, where that information came from. It delivered it perfectly. So because it's a non-farm payroll week, it's already done enough for me. I don't need to do anything else. For you, when you're looking at your economic calendars, it's a real good study for you to do it when we're done with the live stream, or tonight if you go home from work or from university or whatever it is you're doing. Pull up an economic calendar, go to forexfactory.com or Econoday calendar, and look at, for instance, October. Where is the CPI number? Where's the PPI number? Any FOMC? Then look at November. Do the same thing. And look at what day those high impact red folder events, PPI, CPI, FOMC, and non-farm payroll, those are the destroyers. Okay, they are the reapers that are going to come through your harvest and tear it all up. They're the rot in your harvest. So you have to be careful being around them, because if you lay your good money around them, they're going to infect and cause it to decay too. So cut that stuff out of your trading. Don't allow that report or the manipulation around it to affect what you have built or what you're building. So since you're all trying to harvest money, think about it like that. If you're cultivating this opportunity of making money in the marketplace, you're basically creating a farm. And you want to be able to harvest this continuously and have a healthy farm of income. These reports are like a plague. If you don't offer any opportunity for them to touch your harvest, then you can't be affected by them. But you have to be aware of them, because when they're in the field, that means in the week that you're trading, you have to handle yourself carefully, because they have an effect before the day of its release, and they have a specific effect after their release. Trading gets easier on the other side of them. Trading against them up to the point of the release of that data is harder than it needs to be. So if you understand that simple characteristic, that's not complicated, is it? It's pretty simple, straightforward. But you wouldn't get that, in me talking about a 5-minute video, because you're going to have 1,000 different questions. And I've covered a lot of questions that would have came up otherwise by everything I said today. So know your calendar, know your events, know your characteristics, how price is going to behave, know what day of the week the reports are going to come out. Non-farm payroll Friday, it's a built-in thing. It's always the first Friday of the month, generally. And then there it is. It's going to be a Friday event. So if it's going to be non-farm payroll trading, that protocol is you have to trade the Monday. You absolutely have to trade the Monday because Monday's trading on non-farm payroll is easy trading. It's easy, easy, easy trading. And Tuesday can be rather decent as well. But as soon as we get into London of Tuesday, my local time in the United States, you think about New York local time, the London session of Wednesday, which would be technically Tuesday night going into Wednesday morning for me. That London session usually is the last bit of good price action. And then when we get to the New York session, it tends to become messy. But if you look at London last night, that was a shit show because everything that's going on between Iran and Israel. So because they're lobbing each other with you know, terrible weapons of destruction, the market makers they were using London to set the stage for this morning. And you watch what we did this morning. We mapped it out, looked at what was likely to happen with no emotion. I mean, I'm sure it was fun when it was going to where we said it was going to go, and you probably smiled or you probably slapped your knee and said, "Hot damn, this ICT did it again!" And that's fun, that's cool, but it's not something you should try to hop yourself up about. And the same thing, don't be fearful or upset when it doesn't deliver. When you're studying, you're doing a laboratory. That's all it is. It's just a laboratory experiment, and you're trying to get the data collected with experience. The experience is the data. You seeing price do these things, repeating over and over and over again. And if you don't record it, if you don't journal it, if you don't screenshot it, if you don't write down what it is that you are observing. I don't like iPhones. I will never own another Apple device ever. I will never have another one. They're fucking trash. I will never have one. But your phone has a voice recorder if you have an iPhone. Samsung has something equivalent to that as well. While you're watching the live stream, okay, you can have a digital recorder too. Like I have a digital recorder. Like sometimes when I'm driving around, I can't stop and pull over and write down stuff. I used to do that when I was working as a vendor, but now I always keep a digital recorder, in either in my vet or in my SUVs or wherever I'm driving. I don't ever have it in my wife's car because I'm not allowed to do that kind of stuff. When I'm with her, I'm supposed to be just with her. But if I could sneak one in there, I would. But the idea of having a voice recording while you're watching a live stream, like if you see something, like right now we're watching this, it's at 10:06. Okay, so 6 minutes after 10, I want to look into why price is expanding lower after it went back to the consequent correction in the mid gap, and then there it is. Because unless you are logging something, because my videos tend to be long, not this one because we're getting ready to close it. The and it's not a joke. It's not a punchline. I'm telling you, I'm closing it. But every time I say something, it's got a little bit more detail I need to add to it. By you recording it in a digital format, you're not writing anything down. You're still watching price, and you're probably still hearing what I'm saying, but you're not as attentive. But at least you're making a notation about what you want to specifically go back into. Because if you don't do that, I'm going to say something else in the video, or eventually there's going to be a day where I get it entirely wrong. I mean, you have a couple weeks left, right? I might get it entirely wrong. And then you're going to be met with that as something to wrestle with. Wow. Man, he went like 8 weeks and a half of consistently being able to say what was going to happen. But today, he was really off today. And you won't retain anything that was said or something that you would have been thinking about going back and doing your own research on because you didn't write it down, because you didn't record it. And a voice recording is the easy way for taking notes. And then you listen to that note, audible note, and you write it down in your journal as a question or whatever it is that you were trying to do that calls specific attention to it. For those that have the ability to sit down here and write down, you're just going to write down at 10 minutes. 10 minutes. at 7 minutes after 10 on the 15-second chart, fair value gap, question mark, or whatever that interest or concern was. You just write it down, but just still keep watching the live stream. Some of you don't want to do that. That's why you don't watch it live, because you don't necessarily want to be doing anything to copy me. So you're going to get the same experience. That way, when you watch the stream, you can pause it, rewind it again, pause it, write down your stuff, and that's fine. And that avoids having a second watch of it. But for those that are going to watch it live, you're either going to have to watch the stream twice or do voice recordings. You have it on your smartphone, just have it in your hand. And then when you see me talk about something, or you see something in the chart that I'm not referring to, but you're like, wow, I need to take a look at this later on. If you don't do that, you're probably going to forget about it. And that's terrible, because I've learned my lesson. So by having a voice recorder, it's a little digital voice recorder. It doesn't cost that much to have them. When I'm driving around, I'll get an idea, usually about lectures, usually something that I'm going to teach on, or I'll have questions that certain students in my private mentorship have asked me, and I have deferred answering them or deferred putting them into the next lecture like this. And predominantly, it's most of the things I'm talking about are actually questions that I know would come up in my son's mind while I'm talking about certain things. And if it's not that, it's questions that my paid private mentorship students that no one can join. I'm not doing a private mentorship for money anymore. Just stop asking, you can't join it. But I have to tell you that this is the framework of majority of why I talk so much, because I'm answering their questions. You're not privy to what they're asking. You're not part of that community. But I am obligated to that community because they paid to be in that position. So when they ask questions, I look for opportunities how I can show them in real-time price action. It's altogether something different. If I just simply said, well, you're asking about when the fair value gap can become an inversion fair value gap, and what time of the day does that become problematic, and when is it more likely to occur? Well, when I talk about it over price action live, they see me explain it before it actually develops. So not only do I get the chance to explain to them and answer their question, but I'm also demonstrating it with prowess and ability and skill set to prove that it's not something in hindsight. So everything that I do when I'm talking is methodical. It's not because I love the sound of my own voice, because in fact, I don't like the way I sound. But I do want to make sure that my students and my children that are watching these videos, they understand to the degree that I'm willing to share. Because I don't want them to know just a little piece of it. I want you to understand it intimately. Like, I want you to know every aspect about this specific thing and what things have an impact on it, what things are not that impactful for what you're watching me discuss. That's mentoring. That's someone that knows exactly what they're doing and understands the source material. Otherwise, I'm going to talk about it after it happens, like everybody else is going to do. And you're not learning that way. You could just do the same thing. Think about it. Some of you are paying money to people and they're talking about shit in market replay. You know what an order block is by the term. And you can probably go back through the charts and look at market replay and say, oh, look, here's a down close candle. And it went down into that later on at this certain time where I never would have expected it because I don't know what I'm doing. So therefore, I can now talk about this actually happening. And you could talk to yourself in the same way and save the fucking money. You're not learning from those people. They're talking about yesterday's headline news and they're putting a price tag on it. Hey, pay me for yesterday's newspaper. Come on, man. If you know, you know. That's the bullshit. But when you can come out here and say what the headlines are going to be tomorrow, and then the headlines are what you said is going to be, and then you can prove it down to a 15-second interval, suddenly there's something different. There's a stark contrast there. And that's why I do what I do. I stay in an area, in a small little inner circle where nobody else gets to step into. It's just me. I'm in here by myself. And in that little tiny circle, I allow my experience to be viewed by commentary, by lectures, and I share my experience with you. And over time, being exposed to that experience, you will adopt your own experience. And that is the collection of the data that you are harvesting when we do these live streams. Whenever you watch my old pre-recorded videos. It's the same thing. You should be listening. And if you see something in there that's outside the scope of what I'm talking about, take note of that, because what's actually occurring is your subconscious is keyed up on something that is drawing your attention to it. It's interested. Your reticular activating system is keyed up on this very thing. And if you don't pay attention to it, you might actually slow your progress down. If you see something that's inviting your curiosity, explore it, have fun with it. It may be another PD array. It might be a propulsion block. It might be a institutional order flow entry drill. It might be simply the breaker. It could be an inversion breaker where someone would see a higher high and it breaks down and it looks like a market structure shift lower. And if it trades back up to the low of the bearish breaker, you think that that's a short. But what happens if it's really higher time frame bullish? It's going to trade up to that bearish breaker and trade above its candle that makes the breaker and then use that as a bullish order block. That might be your model. That might be your go-to thing. But if you don't explore these little early stages of curiosity, this is the fun part of your journey right now, folks. Like, this is the fun part. This is the most exciting part. Because once you know what you're doing, it's fucking boring. Like, it is boring as shit looking at these candlesticks and saying, yeah, this is what it's going to do. And you lose all that magic of that aha moment, that moment of astonishment, that first experience in your own hands. It's like losing your virginity the first time. It's like, wow, I'll never be able to live this again. I'll never be able to have that moment again. And it's amazing. You literally have this once in a lifetime experience. Every single time you learn something new about that one individual topic. Because once you know it, the magic's gone. The novelty wears off quick. It's literally on to the next thing because I have lots of shiny new objects. So if your subconscious is keying up on something that's outside of the scope of my conversation in the lecture, don't ignore that. Do not ignore that. I try to foster the flexibility in you as the student to let yourself, your personality, and what you're interested in, because I don't know what you're studying, what you spent the most time in, and you don't realize you're doing it either in the beginning. You might go in thinking, I'm going to do what Caleb's doing. I'm going to learn the fair value gap. I'm going to do Cameron's model. I'm going to trade the silver bullet. I'm going to use Michael's daughter's model for 2022, or I'm going to use the optimal trade entry. Fuck all this extra stuff. I've been sticking with OTE. I'm OG for OTE. Okay, wonderful. You got your model. Wonderful. But I'm not going to stop teaching my kids and making content for them because you found out your model. That's great. I'm glad. I want all of you to do that. But if you don't explore your initial curiosity, that you keep seeing things pop up in the chart, and I'm not drawing your attention to it. There's a lot of things I'm seeing in price action. I'm expecting to see certain things behave and certain candles to form this way or that way, but it's not germane to what it is I'm discussing at the time. I'm aware of it. I got 81 ways that I can see all these things doing stuff. But if it's not part of the discussion at that given time, it's not going to increase the efficacy of the lecture I'm trying to deliver. It's actually going to cause too many moving parts, and it's going to dilute the message of that individual perspective or focus for that day or that session or that live stream. So anyway, I gave you an extra 16 minutes, no extra charge. So I'm going to close this one here today. I'm going to wish you all a very pleasant day. Hopefully you learned something today. Hopefully you were encouraged by another tape reading session. You can see what we were looking for, and that is going to be it for today. Until I talk to you again tomorrow, I think, if I'm not mistaken, I think we're going to do another 8 o'clock start. I'll probably be on time this time. But we'll try to be here tomorrow at 8 o'clock or just shortly after 8, worst case scenario, because there'll be a news driver at 8:30, and I want to study that with you real time. And unless the Lord takes me home before that, I will touch base with you then. And until then, be safe.